Good afternoon and welcome to today's Naturally Chicago webinar. It's a great time to invest in CPG, co-presented by our colleagues at Naturally New York and Naturally NorCal. I'm happy to introduce Jim Slama, Managing Director of Naturally Chicago.
Thank you, Bob. Thanks to our partners, Naturally New York and NorCal, and to the Naturally Network for being such an incredible network in 11 of the largest markets for natural foods in North America. Today, we are so excited to report about the shift in funding for emerging natural products brands. In the past few years, economic disruptions were followed by higher interest rates, which severely tightened the availability of investment capital. Fortunately, the growth and promise of our industry, combined with some large-scale exits and other factors, have inspired new funds to be deployed in natural products. Today, 5 of the leading investors in our industry will examine this more in depth. We'll lead it off with the wisdom of Paul Mariani, a managing director of Mesirow, where he leads the firm's food and beverage and agribusiness M&A practice. He brings over 20 years of corporate finance and strategic advisory experience, including the past 15 plus years advising companies across the food value chain. Welcome, Paul.
Thanks, Jim, and thank you to the Naturally Network for inviting Mesirow to participate. I'll try to keep this as efficient as I can, but we're excited to be here and looking forward to sharing what we're seeing in the CPG sector and the capital markets more broadly. So we can jump right in, I guess, once the slides come up.
Yeah, Rachel, can you advance, please?
Maybe to slide number 2.
One more. One more. There we go. And one more.
Keep going.
Yeah. One more still.
Oh.
One more still.
Keep going. There we go. Excellent. Thank you. All right, so I'll jump right in, and again, I'll try to keep this as efficient as I can. We've got a nice large group here forthcoming. Look, I think in a nutshell, we believe we've entered a very unique window of heightened M&A opportunity across the CPG sector. Large incumbents as we all know, are increasingly incentivized both strategically and financially to, in many respects, acquire rather than build, particularly as organic growth across the big food ecosystem has slowed to, I think, just over about 1% over the past year. At the same time, we're seeing a convergence of pent-up demand and strategic necessity. And as such, large CPGs are really leaning back into M&A as a primary growth lever. And we think that will really flow downstream and benefit the broader market. On the sell side, the early stage branded food companies are gaining lots of interest, and we'll touch on some of those factors as we move through these slides. And finally, we're really operating in an environment with I'll put relatively in quotes, stable input costs and improving financing visibility, both, of course, 2 very important tailwinds that impact the market directly. Altogether, we think this creates a powerful asymmetry for early stage investors, the ability to really enter at structurally attractive valuations, and frankly, the potential to exit into a rebounding M&A environment as strategic appetite reaccelerates. If we could go to the next slide. Just a quick snapshot on what we're seeing from an M&A market dynamic standpoint. We are seeing a lot of momentum in food M&A more broadly, and that's largely been led by CPG companies, as the market has really rebounded from the 2022 to 2023 trough. Not only has volume picked up, but there's a much healthier balance of both deal count and deal value, and that's highlighted by the return of the mega deals, and frankly increased activity from both strategics and private equity backed platforms. Another strong telltale that's encouraging is we're seeing in the aggregate CPG growth equity investing has sort of shadowed this trend in mix with dollar volume up about 67% year over year in the first quarter of 2025. So multiples remain compelling, compared to those pre-2021 highs. However, we are seeing more creative structures to bridge some valuation gaps. Scalable brands with loyal followings and DTC strength are definitely commanding clearer premiums, while less differentiated assets are fielding a much more muted response from the market. Importantly, we really believe the underpinnings of the market remain constructive. Capital does continue to flow toward these high growth, resilient F&B companies, but there's a palpable and growing quality divide, if you will. The B plus to sort of A minus assets are commanding attention from the broader market, while buyers and lenders do remain quite cautious for what we call fringe plays. And this has had almost a direct impact on diligence timelines. But I think the good news here is, competition for the right assets is real and intensifying. We could go to slide 4. Just a quick observation, sort of a recap of disclosed implied revenue multiples since 2019. I think the valuation dispersion on this slide sort of underscores the selectivity of buyer appetite. Despite an uptick in higher implied multiples overall, you can see sort of the spread between that first and third quartile really in part underscores the nuances that are being rewarded in the market today. So lots of opportunities for that home run exit in our minds. Next slide, please. We've seen over the years a clear evolution in how early stage food brands do exit, certainly increasingly following a multi-stage path. Initial investment followed by, in many respects, multiple minority equity stakes, and then ultimately that full buyout. This phased approach has certainly kind of become the norm. I think it's really de-risks M&A for buyers and quite honestly gives founders multiple at-bats to drive value creation with the platform itself and of course create some wealth along the way. At the same time, valuations have also, frankly, reset. Post-COVID repricing has brought the, call it sub $25 million revenue brands, even with strong gross margins, really back to a much more capital efficient footing in today's environment, often trading in that, call it 1.5 to 2.5 times revenue. But there is a clear line of sight to more robust multiples at exit for brands that do scale effectively and show consistent velocity among a variety of other factors. Against this backdrop, buyers are definitely coalescing around multiple themes, functional, clean label platforms, think gut health, hydration, protein forward. Those sort of continue to sort of lead the way alongside your traditional authentic brand that resonates with a younger, more diverse consumer. Digitally native platforms with robust KPIs and/or a sustainability alignment also remain very attractive in today's market. And of course, thematic alignment alone isn't the full picture. M&A readiness is increasingly a factor that really separates outlier results from average ones. The market does tend to favor brands that are deemed M&A legible, those with strong SKU velocities, category leadership, clean cap tables, high repeats. So we think for investors or founders without institutional capital, that really means focusing on foundational elements in a business like brand architecture, your cost of goods structure, and building out a multidiscipline bench of talented folks across a variety of those disciplines, all well ahead of an exit process. And I think the good news is, the exit universe is very deep, it's broad, and it's growing for brands that check not necessarily all those boxes, but most of those boxes. So it's still a very, very interesting time. And go to slide 6. Okay, you're already there. Just a few considerations and opportunities. We think as buyer interest continues to build in this environment, we're seeing a much more refined and nuanced focus on brands. At the same time, there's increased scrutiny around durability within a variety of categories. Brands heavily tied to some transient trends, are facing some headwinds in this environment. Channel concentration is another important factor. With rising digital acquisition costs, buyers are really shifting toward more of an omni-channel brand with a demonstrated retail track record. Post-acquisition integration risk is another real consideration. which is why buyers continue to prioritize brands that are operationally clean, margin visible, and execution ready. But we do think that that window is open, but preparedness really remains key. And we can end on just sort of some bullets on looking ahead. Slide 7. Look, we expect, and based on what we're seeing amidst processes and other opportunities coming down the pike, we really expect momentum to accelerate through 2025 as the capital markets stabilize and, frankly, buyer confidence improves. I think the big question mark is the consumer, and the jury's still out on that today. But we do feel confident directionally. The brands that will lead are going to be those with clear scale, a clear consumer value prop, and operational discipline. As I touched on before, M&A readiness has really become a strategic advantage for all intents and purposes. It's really no longer a box to check at the finish line, but a driver of greater deal certainty and we think outlier outcomes from a valuation standpoint. So to summarize again, we're really at an important inflection point. We think in CPG M&A, strategics continue to be very hungry for relevance, hungry for innovation, and are increasingly, I don't want to say unwilling is a strong word, but less willing to build from the ground up. And I think that bodes well for a lot of the folks on this webinar today. I think that dynamic's creating a favorable liquidity window for capital efficient, high velocity brands. And, for investors, one may argue this is kind of the moment to lean in and to back those founders who combine disciplined execution with a deep command of their category. So, and with that, I'll hand it back over to Jim and thank you for the opportunity to speak to you all today.
Thank you, Paul. That was a real excellent primer for our audience and sets the stage well for a conversation with our investors. So let's hear from the panelists. Please introduce yourself and your firm and talk about how you're investing at CPG. Let's go in the order: Arthur, Jason, Mollye, Eric, and Wayne. Arthur.
Hi, everyone. My name is Arthur Chow. I'm a principal on the food and ag team at S2G Investments. We invest across the entire food system, so everything from agriculture inputs and what's happening at the farm to supply chain technologies that are improving better traceability, transparency, better nutrition, and to the consumer end, where I think most relevant for this panel was in CPG brands, retail, and restaurants. We have a mission focus to improve both planet health and human health. And well, we've previously invested in the early stage companies, so from seed, Series A and B. Since last year, we've also started to invest in the growth stage as well, which we define as companies that are about 10 million in revenue, and we're hopefully going to put a $20 million investment to work in a given round. Great to meet everyone, and excited to be chatting more today.
Thanks, Arthur. Jason.
How you doing, everyone? Jason Mercer here at Cleveland Avenue within our Cast Us Fund. At Cleveland Avenue, across the board, we've had a focus for a few years now on CPG, and I'd say all things food, bev, and adjacent technology. With Cast Us, we focus on underrepresented founders. So that is something that I've been working on very closely for the last 5 years. And with that, technically, we are more or less industry agnostic, but I'd say a good portion of our portfolio within Cast Us is within the CPG space. So excited to continue to talk with you all from an investing standpoint. We've done really, I'd say, seed to Series A. I talk about it as we want to be that round just before Series A. And in today's world, and we'll talk about it, you see a lot of seed plus, there's seed ones and seed two, so it's kind of hard to really assess what that looks like, but that's where we want to be.
Great, thanks, Jason. Mollye.
Hi, everyone. Thanks for joining us today. I'm Mollye Santulli. I am an investor with Springdale Ventures. We invest across consumer, food, beverage, alcohol, beauty, personal care, supplements, pet, any branded product you can bring into the home to make life better at the seed or Series A stage. So usually brands doing 1 to 15 million in revenue is where we invest, and really focused on removing barriers for our founders. So whether that's making intros across our network, helping you find the best agency for whatever you might be doing, really focused on making things easier to scale and get to that next stage of growth. Thanks for having me.
Excellent. Thank you, Mollye. Eric.
Hey everybody, excited to be here. Eric Schnell, I'm the founder of Beyond Brands. We've been in the industry I'm 28 years in the industry, but in the industry with Beyond Brands for a decade, serving the early stage community. The primary market we serve, food, beverage, supplement, beauty, and spirits is our focus, but our primary clients' focus is really getting their brand launched and incubated. So we're kind of a one-part incubator that meets founders at concept and helps take them through that first couple of years to get to actual production in the important year one launch in the market. We have a capital side of our business called Beyond Ventures, which for the last 10 years has accumulated over 50 equity positions. And many of these companies we're writing the first check in, like the pre-seed check or the actual seed check to kick off their first rounds. We have a model called Backed by Beyond Brands where we help these founders get on their cap table. We act as their early stage management team, often on a fractional basis, and really help them get running safer, smarter, faster to scale, hopefully to Series A. And we also have our own accelerator program called Beyond CPG, which is in our 6th year in New York right now, really serving again the early stage sub $1 million brand community. So excited to be here and excited to represent the startups on this call.
Thank you, Eric. Last but not least, Wayne.
Hi, everybody. I'm Wayne Wood, VMG. So for those who don't know VMG, we probably been one of the most longstanding investors in consumer CPG and services. Personally, I've been at VMG for a bit over 17 years, so not quite as long as Eric, but Eric and I have known each other for quite a long time, nevertheless, and excited to be here and thanks for having me.
Awesome. Well, thanks for joining us, Wayne. And thanks for this esteemed group. Let's move into some questions. Eric, can you briefly talk about the level of investments and when brands should utilize them to raise capital?
Yeah, so I think when we look at the Naturally network as a whole, we're 7,000 plus members, 11 chapters. Obviously, we have 300 board members that lean in and help each of their cities or their states to really develop what we call developing future leaders at Naturally Network, and that's really the early stage founders and entrepreneurs. So, we just had a spring fling last night in New York, and I'd probably guess 40% of the people in the room that are members are first-time founders. Many of them haven't even launched their brand yet. They're joining Naturally Network to come learn, to come be part of an ecosystem, and to meet and connect with people that could help them fulfill their dream and maybe even support their business, whether it's through working with them or introductions or possibly investment. So we get like the same questions all the time when we talk to our early stage founders at our events, and certainly a lot of us speak directly to anyone that wants to reach out to us on our board. But what they ask is early stage founders, first time founders don't understand mostly what the different rounds are called or what they even mean or what it means to get to a Series A or B and what is an exit actually, how does it all work? So I spend a lot of time talking them through this model. So I'm a 7-time founder myself over the last 22 years, so I've been through every round you can imagine. I've raised about $100 million myself. I've had 4 exits, and so I've got the experience to talk to them where they're at and meet them where they're at. But I'd say first of all, what we tell everybody is you've got to, just as a founder, if you can't see your way yourself to raising about $100,000 from friends and family, however you do that, probably can't move forward too far in your business because you're going to need that for the pre-revenue year one to build out all the aspects of the company. And then when we look at the first kind of round, what is that called? We call that, a pre-seed round. That very first round, and maybe that's 100 to 150,000. The very early round could be friends and family, and that may be just direct equity on the cap table. Once you get into the seed rounds, what we see on average, a lot of first-time founders think there's just one seed round, then there's the A. What we see on average is probably 80% of the time there's 3 seed rounds. You can call them seed 1, seed 2, seed 3, or A, B, and C. However, the lawyers like to kind of mark that up and call it. But generally, these rounds are $250,000 to $500,000 for the first, $1 million for the second, maybe the third seed, which would be the last one or the bridge to the A. We call it a bridge to the A often. That's maybe around $2 million. And in all 3 of those rounds or whatever seed round you have, generally, what's popular is a safe note. So, most people can get that information online from Y Combinator. When I was a young entrepreneur, it was all about convertible notes. And what's really popular now is obviously val caps or valuation caps. So every one of the brands I speak to does not understand that. Like, well, how do I come up with a valuation cap? Or what does that mean? The way I'd explain it as a fellow entrepreneur and just what I've seen tested, because speaking to all my VC and private equity friends, that there doesn't seem to be a defined definition for how you negotiate a val cap. I would say, if you're at 0 revenue and you're putting your first seed round out, so you don't have any EBITDA or revenue to base it off of, I would say whatever your annual projection is at the end of year 1, 10x that. So if you're going to do $1 million year 1, that's your projection, do it 10 times on that. Or if you're already in business, you've already got revenue, maybe you're a year or 2 in and you're doing a seed round, whatever the raise is, call it $500,000 or $1 million, do 10x that. So either way, you're going to end up with starting the negotiation in a pretty good place at maybe 10 million or 10x revenue or raise, it's always going to be negotiated down by whoever the lead of that seed round is to probably somewhere 30-40% below that. So that's my advice, to start, and maybe end up somewhere, right at the 5-time level. I'd say once you get past that, the two rules of thumb I've always, had in all my deals, I think they're still relevant today. Numbers may change, but a Series A is 5 and 5. So always use this 5 and 5 number. You got to be at a 5 million run rate, and you got to be, taking in a round of 5 million. It's got to be worth it for the lawyers, worth it for the cost, worth it for everyone that's going to lead that round, whether it's 1 or 2 or 3 private equity groups in a syndicate or VCs. There has to be enough meat on the bones there of an investment to make it worth the while. So don't talk about doing a Series A at $1 million in revenue or 2 million revenue. That's not a Series A. So 5 and 5. And that money should get a brand to 10+ million in revenue. I'd say when you're in the 10 to 20 million raise, you're in the Series B area, and that's a 10 and 10. You're 10 million, run rate or 10 million revenue that year at least, and you're raising at least 10 million. And that Series B round could be the round or should be the round that takes a founder to exit or the co-founders to exit, or maybe a Series C. I've been on those two. So that I would just say that's the universe of just explaining it with simple to hear terms, and I hope that's helpful.
Very helpful. Thank you, Eric. Wayne, we had a great chat in our prep call. Can you talk about your perspectives on the current state of capital availability in our industry?
Sure. I guess from my perspective, I think the easiest way to think about this, or I guess most effective way, is really thinking about like the last 20 years of capital availability in consumer. So if you guys bear with me, I'll reverse back into like 15, 20 years ago, when VMG first started. When we first started, which is where I met Eric years and years ago, there really wasn't any of the nomenclature that Eric explained. There was just basically like, it was really more of like a tech construct of seed and all the various seeds and series that Eric described. There really wasn't any institutional capital in this space other than probably TSG and Catterton, maybe a little bit of Swander Pace at the time. And as you kind of move through, and so how did people fund businesses back then? You literally saw, I mean, the number of times I've seen like mortgaged homes, or they're raising from quote unquote friends and family or things of that nature. It was really pretty scrappy. I think what the tangible result was, you just saw by the time, it got to any type of institutional phase, you just had you end up having to build more gross margin into those businesses because they had to find a way to get it funded. You kind of get into the kind of past the great financial crisis, kind of head into like the 2012s and beyond. That's when you really started seeing the industry ramp up into more early stage investments, and that's driven on some of the interest in the large strategics. You see a number of transactions that occurred during that time period, whether that was like a Pretzel Crisps, to a Snyder's Lance, which is now part of Campbell's. You saw the exit flow happening, and then you saw capital coming in more of the early stage. And you see that over kind of 10 years, over all the way to COVID, and it probably peaked out around the COVID time period. What was the upshot of that capital coming in at an early stage? I think, unfortunately, there was almost too many new people coming in who hadn't necessarily been in the industry, and there wasn't enough returns that came back from that early stage risk that a lot of those new institutional investors took at that extremely early stage. And so you still see a lot of that capital tied up in companies that are, kind of somewhat mature, but they had been deployed during that time period. I'm getting to my point, which is then you saw a lot of interest in the LP community, in consumer as a whole. So you see a lot of funds being raised. And you still have that today. So leading up to the current state of the market, if you look at the total capital in committed to consumer funds, I don't know the specific, I don't want to make an absolute data point. I would venture to guess we're at one of the highest points still in history of committed capital dedicated to deploy in consumer. What I think has certainly changed is just what stage it's willing to invest at. and at an early stage, what that profile of company looks like. And I was very, I think Paul said it very well in terms of like what strategics are looking for today. I think as you walk backwards on like the investor waterfall of different stages, they're basically looking at the same checklist that Paul described related to gross margins, total addressable market size, velocities at retail. I find that investors are less willing to bet on a narrative of we're going to get gross margin later, or I'm getting this distribution, but there's no sell through yet. We're going to build the total addressable market, but it doesn't really exist yet today. Investors are unfortunately or fortunately choosing more to wait to be able to see how gross margins and velocity play out. So as a result, I think once those occur, I would argue there's maybe more capital than there's been, because so much of the capital is triangulating to a very similar profile, where during 2010 to 2020, you saw much more dispersion on what people would find acceptable in terms of profile that they're willing to invest in. So what's the upshot? Total consumer capital still very high. Shift to slightly later stage, oftentimes triangulating to a very similar profile, where the outcomes are the haves have almost like more options than they ever have. Unfortunately, the have-nots don't have as many options as they once did. And what are those attributes? Paul outlined them well, because people are working backwards from those attributes that strategics are looking for.
Thank you, Wayne. That's a really valuable perspective coming from you with all the experience that you've got. Jason, at Cleveland Avenue, you lead the CAST US Fund, which invests primarily in diverse founders. Can you discuss how the backlash against DEI is impacting this?
I mean, I think it's obvious. It's been a huge impact. What is interesting, if you think about some of the backlash at some of the retail level. So I think there's a lot of research out around how Target, who leaned in pretty heavily in doing some diverse focus buying of sorts, their store traffic is down because they pulled back on it. And a lot of their customers said, hey, we didn't like that, and there's various reasons. That's really impacted a lot of Black and women-owned brands. So I think more than anything is a lot of what we hear from the government in different spaces is just creating a tension where retailers and different large-scale buyers are saying, do I want to cancel these programs because I don't want the government coming at me? Or if I don't cancel these programs, half the country is upset with me. If I do cancel these programs, half the country is upset with me. And I think retailers don't know what to do. And when retailers don't know what to do, they aren't going to buy new products. They're going to stay true to what is driving customers to stores, what's already coming off velocity. But being a new customer coming in, the diversity angle, I think, plays, is not as well as it did before. That being said, I think all companies should be have to be more focused on their products. Your product needs to sell in no matter what. And if diversity or being woman owned was an angle that you could play as more of a way to gross up, I think that's great. So overall, I think it's been tough. And then from an investing standpoint, I think it's only been an issue in that it's another obstacle, I think, for investing. Raising funds is tough for everyone. The data shows for folks that look like me or women, it's even more difficult. So in a time like now where people are there's so much combativeness, it just becomes another issue where even if I have a great product, I have to defend this component of management, and that's just unfortunate. That being said, I think what Eric and Wayne said, the numbers are the numbers, the products are the products. I think great products that are selling well and you can tell the story are always going to do well. But we are in a place where there's a little bit more, headwind than before.
Thank you, Jason. Mollye, how are investors looking at valuations?
Yeah, thanks, Jim. I think, kind of circling back on what everyone's talked about, the product quality, some of these key metrics really do lead investors to think about valuation. So whether that's velocity, repeat rate, if you can get that data, door expansion efficiency, and then cash flow management. Those are some of the key things we're thinking about. And then to Wayne's point earlier, I think the other place where there's probably some more focus and we spend a lot of time than there was in the 2010 to 2020 time period is on margins. And we're thinking about, when we talk about margins, we're talking about product margins. So, what truly does your COGS look like? How can you grow and scale efficiently? How can you improve those product margins? But then also contribution margin. If you are selling on D2C, how much are you spending on marketing to acquire those customers? So that's a place where we spend a lot of time digging in that helps us inform how we think about evaluation for an early stage business. But I think the way we break it down when we're talking to founders and digging into diligence is we're looking at trailing 12-month revenue. So a lot of times when we talk to founders, they want to talk about, their forward-looking revenue, which at an early stage is also very important. And we usually triangulate a little bit between trailing 12-month revenue, a run rate for maybe the quarter, and then the forward-looking revenue, and try to back into a valuation that way. And we really try to make that a discussion with our companies that we're doing diligence on. So I would always encourage founders to make it more of a conversation, not come right out of the gate with exactly what you're expecting, but really say to an investor, how are you thinking about a valuation on my business, and make it more a conversation, because it should be a win-win for both parties. And the reason I say that is because we're usually, as investors, thinking about the long term with these businesses. And so we're taking a couple things, the current run rate, maybe the next year or two, but then also to Paul's point at the beginning, what have exits looked like recently in the space? So looking at your category, what has the revenue been for a bunch of companies in your category, whether you're in beverage or food? What was the revenue? What was the EBITDA of those businesses? And if you're raising now at a $10 million valuation, what does that mean you need to do over the next 5, 10, 15 years to get to one of those exits? And so investors like us at Springdale, we're thinking about the exit valuation, the current valuation, and what makes the most sense to incentivize the founder, the team they're going to build, and the investors that come in along the way. So I think that clean cap table question, do these fund investments over time level up to the exit that you're looking for, is really the most important thing at the earliest stages, because unfortunately, if it's not set up the right way at the beginning, it's really hard to go back and fix it. So we spend a lot of time with founders kind of walking through our math on our end, and then how to get to that outcome that we're all looking for. But yeah, I think my main thing would be to just encourage founders to make it a conversation, and always ask questions, because it can be kind of confusing, especially the first time you're doing it. But that's, a little bit more about how we think about valuation right now.
Right. Good advice, Mollye. Thank you. Arthur, what is your perspective on attracting capital from strategics and the advantages of that path?
Yeah, I think it's a good question overall. I think in this environment, especially, a lot of, I think, positive benefits. And at S2G, we're a big believer in building syndicates, and especially those that can be a real value add and voice in the room in a board setting. So I've seen many examples. I think the obvious one is that it can be a real accelerant to business development, whether it's a JDA or partnership, something commercial, where that most of the time a strategic is investing because of that commercial potential. So to be able to accelerate that in a big way. But usually with those large companies, they have a lot of resources. So everything from R&D to understanding legal and getting help with patents, even to operationally, where I've seen some of our companies been able to use strategics in a way of distribution and better warehousing. And so there's a lot of aspects that they can bring that are positive. I think you do need to, with some caveats though, and careful about, these are public companies, and so they are managing balance sheets and thinking about how, I think a little bit more atypical, the people managing corporate venture capital tends to move around or shift around a little bit more than you'd have at an institutional investor base. So you have to watch out that making sure that your champion within the company is there. But I think in thinking through that, then you have to think through, they may not be able to participate as much in future rounds. And so just kind of going in with eyes wide in with that expectation, or with some of those watch outs, is important. But I do think I've seen it sort of time and time again where they can really be helpful in accelerating that business and taking a step change function from a Series A to your next round.
Right. Thank you, Arthur. So question now for the full panel. Can each of you share suggestions for brands that are raising or getting ready to raise? And feel free to jump in.
What size round? Is this seed or are you talking larger? It's a different
Uh,
strategy for a priced
It
round.
is different strategies, but
So
let's say seed, so it's an earlier stage round.
I'll just take it because I live in the world of seed rounds, probably more than anybody on this call. I always say for a first seed round, take in more than you need. So, and I also like doing the first seed round if I'm, supporting a founder that's asking me to help them before there's any revenues. So raise, obviously, there's got to be a great business plan, a great thesis. Hopefully, they can prove their category captain status, maybe top three in a new category or subcategory. Brands like Half Day right now, that's creating a new subcategory in the Olipop world of bubbles. They're not bubbles. Like they've created an opportunity to say, I'm a category captain. We're going to lead this new growth in your store. I think if you got some of that magic, first mover advantage, a top three, something different, it's a compelling story. You've got a solid business plan for 5 years to show the size of the prize to investors. And when I say size of the prize, I mean, you should, whether it's food or beverage or supplement, your 5 year number should look something around 25 million. If it's 0 to 10 million in 5 years, that's not as attractive to any real investor, maybe friends and family and early high net worth individuals, but try to get to that 25 million and back it down. And it's obviously going to be a national rollout at some period, probably year 3, 4, but really build the financial strong, get the margins in place, get the cogs to look good as best as we can model it, and raise as much money as you can, not $250,000, not $500,000. You can go for $1 million on the first round because everybody's betting on emotion. All the early investors are friends, family, high net worth individuals. They may even be the ingredient suppliers or the co-man that's kind of taken a liking to the founder. So go bigger because I see 80% of the time you get to the end of the first year and you didn't hit your goals, you didn't hit the number that's in the plan, and then you have to go back to all those investors and raise money again, or they say they want to wait to the end of the first year and see. And generally speaking, everyone's off their numbers, even myself when I've launched brands. So it's really hard at the end of the year to sell them on the bigger prize and sell them on the belief that the valuation is even what it should be. So go big and go early. That's my number one recommendation for a seed round and a seed round strategy. I used to love convertible notes, but safes are popular now. Be prepared to talk about a discount, off of that, which is generally around 20%, and whatever the coupon is, the interest rate, if it's a safe or convertible, be prepared for all that. And I said the last thing is if a founder can build at least a few advisors on their team and their deck, 2 or 3 people that got experience in the industry, it super helps the believability for investors to come in to feel comfortable that it's not just 1 or 2 founders that have never done this before. So that does add a lot of value.
Arthur, how about on the growth side?
Yeah, on the growth, it's much more, I think, as Mollye talked about, like look at trailing 12 months and kind of we need to sort of see it today to believe it, the more so about the future. So it becomes a little bit more, let's say formulaic, but more dependent on that, looking at that velocity and some of the data within the leading or lagging indicators, looking at your distribution overall. And so just having the sophistication within your team to really understand where your trade spend is, where your promotion is, and how effectively you're growing in retail is super critical. Because at that point, you're hoping it's less about the product market fit risk and much more about the execution risk that it's working well in a few certain channels or areas or stores, and that you can copy and paste that across different channels and across the whole U.S.
Right. Thanks, Arthur. Wayne, you've been one of the most successful investors in the natural products industry. Can you share a few examples of companies that you invested in and then led to exit? Specifically, what attributes in those brands inspired you to partner with them?
Well, thanks. That's very kind. I think I'll pick one just because she's so involved in Naturally Network is Cynthia Tice. I think she's on the board of Naturally Network is is on Lily's. So she's the founder of Lily's. Very unique situation. I bring this one up because it always stands out in my mind. I don't think I've ever had a situation where she sent me an email that said, "I've decided I want VMG to carry the torch forward." Now, and she said, "I've done all my homework and it's you. I just want to figure out however this happened." And so and coincidentally, it was already a brand we had been tracking. And so I'm gonna go fast because I know we're low on time. The upshot is she had a 4-person company. It was Cynthia, her 2 20-something-year-old kids, and a bookkeeper in Seattle before remote was a thing. And she had built this, teens revenue kind of business And she had really hit something. The gross margins were good. She had created this delicious product that was, no sugar added, and the velocities were just super, super strong across all of her initial channels related to natural, as well as some early proof points in conventional. What was interesting about on gross profit was because she had the experience of being working with a number of brands in the sales function. She had really nailed gross margin even in the natural channel selling through UNFI and KE. And so, which for her, the company was just growing at such an astronomical rate. Her question was like, Wayne, can you build us a team in 30 days? And so, upshot is we ended up making an investment, closed really quickly, helped her build a team, I think in like 30 or 40 days, led by Jane Miller, who has worked with us at Justin's, and she had previously been at Rudy's, and stood up a team in Boulder and built that business over roughly 3 years, and ultimately sold that business to Hershey after that point. But really a great run together. Cynthia's still a magnificent friend, and I'm still thankful today that she sent that email to me, who essentially anointing VMG to be her partner.
That's a great story.
It still hasn't happened again. I don't know if it ever happened again where someone sends an email anointing us, but that was, I feel very blessed still today.
That's great to hear. And I know Cynthia is part of Eric's and the Beyond Brands team.
I'll tell you, just to add to that, so every founder that's on this call can hear it, checking your ego at the door as a founder or co-founder is one of the most important lessons you're going to hopefully not have to learn. When you get to Series A, if you're not up to being the CEO, it's okay. And at the Series B, if there's someone better that's done that before, taking a brand from 20 million to 100, let them be that role and do it yourself before the board does it for you. Cynthia was smart enough and had the foresight to check her ego at the door with you, Wayne, and she tells that story exactly.
Yeah, great. Hey, Jason, question for you. There's a lot of brands that are struggling. Any advice for folks that are just really having a hard time making it and not able to access the capital that they need to go to that next level?
Man, Jim, you gave me the hard one. I think, and it's easier said than done, got to get ahead of it. You have to understand your business, your get some sense of understanding where your revenue is going to come from. And I realize it's difficult because rebuy, cycles for different, retailers or whatever. But you got to get ahead of it, at least 6 months. And be honest. I think another part of checking your ego at the door is if on your current capital, you think you're going to be out of funds in a year, you need to be honest with yourself and essentially start trying to fundraise immediately. We see a lot of founders that I won't say hope is a strategy, but they're like, okay, we might get this order to come in, or we might do that. And if we get a little upswing, we could see where we're at, at month 6. It's too late by then. By that, then you're really looking at some version of a miracle to come in because fundraising takes a long time and you need strong metrics. So if your metrics are just okay, if you get out ahead of it, you got time to think your best bet is saying, with a year out, tell people I'm calling my shot. I'm going to be here in 3 months. I'm going to be here in 6 months. I'm going to talk to you every month. And if you're there, you might have a chance to get them because what you are building is that trust. You're going to the set of investors saying, I know my business. I know how to run operations. I can project and forecast. And my growth may not be incredible, but because I am growing and I'm telling you where I'm going to be, I'm now showing how strong of an operator I am. And now between the rapport we're building up, calling my shot and actually hitting those metrics, you might get them to come in for something because they now believe that, hey, with more funds, this person now can even do more. So if they were to call their shots with a little, they'll be able to call their shots to some degree with a lot. So getting out of ahead of it, being very honest about where you can be in certain milestones and going after and achieving them is what I'd say. Because if your metrics are already not good and they don't get better, time is not on your side.
Yep, no doubt about it. Great. Thank you, Jason. Rachel, we're going to go back to shared screen just for a brief Naturally Chicago commercial. We got a couple of cool things coming up that I want to make you all aware of. Well, there we go. All right, so just want to let folks know, become a brand partner today. Our locally made program is crushing it. Whole Foods, Fresh Time, Mariano's, Costco, Walmart. We're connecting brands with retailers across the natural product spectrum. For an emerging brand, it starts at $500 a year. We've got a great mentorship program. We've got 70 plus investors in our network. You definitely want to be part of this network. Thank you. Next slide, please. Our naturally rising conscious pitch competitions, June 2nd in Chicago on Michigan Avenue. Seth Goldman, the founder of Honest Tea and now the CEO of Just Iced Tea is his company. Sorry, I forget the brand. Anyway, Seth's giving the keynote. We've got a panel of 5 of the top retailers in the region speaking. We've got 3 food service gurus. They'll be bringing their team, so there's going to be a lot of buyers in the room. And we've got 6 amazing brands pitching. We'll be announcing those brands next week. Next slide, please. And Chicago Seedco for the investors on the call. It's a great network. We have investor-only bi-monthly roundtables, pitch nights, where we bring in brands to pitch to this great network, quarterly networking socials, and educational programs. If you're interested, check it out. You can always send me an email or check in with our team. Thank you. So now we're going to go to audience Q&A. Rachel, you can stop sharing. So let's see. Jonathan Ostroff, a Chicago brand, Fusion Foods. CPG brands face growing competition from white label retailer products. How have you worked with the support of brands navigating this challenge through institutional capital availability? So anybody want to talk about the brands facing white label retailer products?
Been going on for decades. And if you've got something you're launching and you're proving it out and the velocities are there, obviously the stores you're selling in will see that velocity, and they have their own private label teams. Wild Oats used to do it all the time before they got bought by Whole Foods. They knocked off one of my brands. Whole Foods knocked off my brand Steez in the beginning and copied my energy drink and just said, sorry, that's our private label team. We can't do anything about it. Happens all the time. I mean, it's a bit of flattery, but the truth is I've never seen it actually really kill a brand that's branded on shelf. Now, obviously, you've also got the opportunity that right now, like Ahold and others are asking brands, do you want to provide your product as private label? And we've got one brand right now in our portfolio, Rule Breaker Snacks, that has pivoted for the most part, 90% of their portfolio to be their exact ingredients, just the brand name of the actual, like Aldi right now is their #1 private label partner. So they actually pivoted from being a brand to now being a brand that provides private label under its exact ingredients. And they're happy with that. And the margins are like 30%. So that's working. So everything's different, I guess, in terms of each deal and why someone's knocking you off and what the end game is.
If I could double on that, I think that makes a lot of sense. So I think Eric's point, the game's the game. It's going to happen. So I'd say try to get in front of it. Depending on your relations with the retailers, as soon as you get a whiff of it, how do you talk with them? I think the power of the brand and your story and all that stuff is always going to be so important. But if the product is that good and they want to private label it and consumers are more, and your branding and their story don't get them to get to the brand, you kind of have to see, how do you partner with them and think through it. I think some of that does come down to how you're getting the product made. If you just add a co-packer and you don't have some control around the formula or whatever, then you got to think through that. If you're self-manufacturing, it's a way to boost volume because I think all of us need more throughput through our factory. So if you get out ahead of it and then see how you think about it from a market branding story, also with like a volume story, there could be opportunity to do a little bit both, but there's no way to really avoid it.
Right. Thanks, Jason. Wayne, we've got a question here about valuation for snack food companies, which you've definitely played a role in a few over the years. Any sense of what kind of multiples, whether it be EBITDA or sales on snack food companies?
I don't even look at it only specific to snack. I think a way to look at it is there's always going to be outliers to everything, but I've seen a lot of folks look at it from a standpoint of working backwards on, hey, 15 to 20 times EBITDA on a strategic exit is on the it's a massive win kind of multiple is the way to look at. There's always certainly things that may be higher, and then if you're anywhere in that zone, it's a massive win.
Got it. Yep, I agree. Paul, can you share advice for brands that are preparing to raise capital or exit? What steps do they need to take from a investment banking perspective?
Sure. Yeah, look, I touched a little bit on this notion of being, exit or M&A legible. We spend an inordinate amount of our time talking about readiness and preparation, and at a very basic level, making sure your house is in order across a variety of disciplines, and that's probably resonates more deeply with non-institutionally owned folks that have yet to raise capital and are kind of going it alone on a family founder-owned basis. But I think just maybe to hit some high points, frankly, very intuitive, just knowing who or what you are, what you are not, right? Understanding your core, and being able to clearly articulate your category position. Ideally, as Eric said earlier, top three sort of on your way to category captain, category leader. I think where we see some shortfalls is on the data side. Quite honestly, having really, really strong data reporting abilities from a system standpoint, whether that's at the product, SKU, customer level, that data is going to serve as a foundational element on a very comprehensive diligence side of the equation. It's going to be incredibly important to be able to produce quality data and produce it quickly and readily as you think about potentially undertaking an exit. Thinking about complexities in the business, whether that's SKU complexity or operational complexity. Jason said this a number of times. You got to get in front of it. Like getting in front of those components is very important. The notion of not being all things to all people and really having sort of a core belief and mission strategy from a product SKU standpoint. And then, of course, building the right team. I know all this is, sort of housekeeping 101, but both real time and down the road, thinking about how to fill functional gaps. You don't necessarily have to do all this today, but being able to anticipate, know where the puck's going to go from a variety of standpoints, understanding gaps in your team by discipline, and finding yourself in a position to sort of prioritize and stage gate, filling those gaps. Again, doesn't have to all be done pre-exit, if you will, but you need to sort of be able to articulate the challenges and the opportunities, quite honestly, down the road. And then I guess lastly, just build relationships early. It sounds kind of hokey, but really talking to people, because there's just so many different perspectives out there, and really surrounding yourself with, whether it's brokers, trade shows, investors, certainly. And those that don't have institutional capital, self-serving comment, investment bankers are a great resource. But I think those are sort of the key elements, kind of keeping that flywheel spinning and staying in front of some of the perceived gaps in the business, and being able to anticipate and or articulate how you would address those gaps tends to be sort of a fluid dynamic as you think or start to think about a potential exit.
Right. Paul, when you mentioned data and the importance of data, was that a reference to like spins or NIQ data, or is that more kind of internal data, or both?
Well, both. The spin, yeah. Retail insights are great, and you can, if you don't subscribe, you obviously can buy it. But yeah, really internal, really evaluating your internal operational and financial reporting capabilities, and being able to understand where the gaps are and where investments may be needed, so that you can produce high quality real-time data as you start thinking about getting in the throes of a diligence process.
Great.
Jim, can I just add one thing to Paul?
Yeah, of course.
One of the ways that we're seeing successful early stage raises happen across National Network, it's the reason why we do these 11 pitch competitions and then the national at Newtopia in August. The reason why we do this is to give these early stage brands an opportunity to get in front of an audience that's mix of investors. Any one of these groups has, or these events has 200-300 people at them. Lots of investors. Naturally New York is having a pitch competition next week on May 6th. Please go to the website naturalnewyork.org, and Naturally NorCal next week as well on the 8th. Please go to their website if you're interested in joining, if you haven't done that already. But we see lots of connections afterwards. And I would say one of the number one things as a young founder, showing up is everything. Get out there, whether it's New Hope's pitch, it's BevNet's pitch, it's probably get out there and pitch your butt off and show up. Showing up is everything in capital. It's a dating game. It's a long play.
Yeah.
Yep, no doubt about it. Mollye, earlier we talked about advice for founders that are going out and raising capital. You work much more so with earlier stage brands. Anything more that you have to add
Yeah,
to that
no,
on the advice side?
Yeah, no, I love what Eric said about getting out there and meeting people in person. I mean, it's hard to keep going to events, but also I do think I agree that building those connections in person and showing up goes a long way with investors. And then the last thing I'd say, if you can't get in person with people, is share as much information as you can over email and that you're willing to share. Investors keep things confidential, and it's really helpful for us to have something to look at before getting on a call. And then the warm intros are great too. And especially within the founder network, if you know founders that you're building relationships with that know investors, reaching out to them and saying, hey, how can I get in touch with this investor that I, really want to speak to, I think goes a long way. I think most investors try to get through their inbox and reply to people, but those warm intros, those in-person connections, and being willing to share your story and your brand story goes a long way and helps build those relationships for the long term.
Great. Thank you. All right. Lightning round. What are we going to see in the next 12 months? Start with Eric.
What are we going to see in the next 12 months?
Yep.
I think one of the most creative things, because we're right now I'm in the sub 3 million brand world, and it's extremely hard. That hasn't gotten as good as the rest of the world. But I think talk to your co-packers, talk to your ingredient suppliers, talk to the early partners that are already working with you, whether it's your service providers also. Many of them do invest, or they convert actual invoices into an investment. So look in creative ways. Showing up is everything. And please join the pitch slams if you're part of Naturally Network.
Good advice. Wayne.
I think resilience, persistence, which is, the mark of any great entrepreneur. And I think this time is no different. And be comfortable being uncomfortable, because there's daily things that change the environment, and just keep rolling with the punches and sticking with it.
Yep. Life of an entrepreneur, eh? No doubt. Paul.
I think on the more mature exit side, I think we're going to see the market stabilize. I'll echo Wayne's comments. I think we're going to see more resilience, continued strategic buyer acceleration in the CPG world, and more re-engagement from private equity is probably the biggest swing in the world that I live and breathe in every day.
Good to hear that. Mollye.
Yeah, I think mine's more on the founder and brand side, but more creative ways to reach your consumer. So whether that's TikTok Shop, going live on streaming, we're really excited about some of the creative ways people are finding ways to engage with their biggest fans.
Excellent. Jason.
I guess leveraging a bunch of these, I see more bifurcation in the market. Companies in tough positions that aren't exactly doing well are going to have a tough time raising funds and may go by the wayside. Companies that are doing well, that have got ahead of it, either have some runway now or currently raising, I think they're going to have success raising those capital. Now, what the valuation is, who knows? Similar for M&A activity. I think we're going to see more increased M&A activity for folks who are doing well and have a few years of strong CAGRs. Again, at what valuation? Who knows? But I think the folks that have kind of been prepared for this moment are doing well. Will see funds come to them, and we'll be able to, foster growth, because people want to invest here. They want to invest. They want to see folks grow. There's money to be made, but people are going with the, quote unquote, proven things, as opposed to folks that, for whatever reason, are struggling.
Great. Thank you. Arthur, last but not least.
Yeah. So I do think of the sort of side of the resilience theme, just the focus on supply chain and having alternative sources or insourcing bringing that near shore. Obviously, a lot of turbulence with tariffs and things right now driving that. But I do think in general, as folks get more, just understand that's a big strategic part of the component for CPG. And then the second area is around with these exits that have happened and some of these marquee transactions, there's more capital returning to investors. I think it's something we talked about in our prep call is as investors finally get that capital back in, they can return that to their LPs, and then their LPs can then go and invest in more funds. And so I think that that's so critical for our industry is to see those exits and to have that capital, that interest then from these investors who will be looking for that and to be able to actually raise their own funds.
Right. Thank you, Arthur. Before we go, I want to wish Rachel Iglesias a happy birthday. Happy birthday, Rachel. And
thank you very much.
and I want to thank all our panelists. What a great group. We're super excited about this. We'll be sharing the recording with everybody. Bob will write a nice blog about it. Again, please share it with your networks. And thank you so much for joining us. And thanks to our audience for joining us. We'll see you again next time. Bye-bye.
Thank you.
Bye.
Cheers.